more concise matter, and what I'm going to do is actually click through the slides of pre-drawn material, but understand that it's the point. All right, so here's how the market starts. We're going to look at the 24-hour market maker cycle in the Forex market. Okay? Need to grab a pen. Hold on, so I can mark a little bit. Okay, here we go. Every day at 5 p.m., the high and low reset right here. This is the daybreak line right here, 5 p.m. This is most dealers. And by the way, all times are Eastern Standard New York. Okay? Standard time. The dealers will come out at the open, and they will move up about 15 to 25 pips to the upside. What they're doing is they're setting a thing called the market maker spread. Don't confuse this with the dealer spread. Two different things. The dealer makes profit on the difference between the bid and the ask. The market maker sets his range during Asian market or initial market hours to start accumulating and straddling contracts. Okay? So he makes a quick push, 15 to 25 pips up. What happens? Jeff Gilman gets excited and he goes, man, Steve, that looks good. I'm a buyer right now. I'm a dealer. I sell to Jeff. Then what happens? A few minutes later, they quickly pull back and they go down 15 to 25 pips. And this is based off of the open, okay? In the open right here, at the open price, they will go up 15 to 25 and down 15 to 25 from the open. Eugene gets excited. He sees it going down. He's a seller. I'm a dealer. I buy from you. This behavior goes on for 6, 7, 8 hours, 10 hours, whatever the amount of time that is necessary for me to build up my float as a market maker. I set the IHOD in this process, which is the initial high of the day, and the initial LOD, initial low of the day. I trade within that range and see how the traders straddle the market. Remember I mentioned net longs and net shorts? I'm looking for some imbalanced accumulation to give me success as a dealer in the marketplace. Okay? Let's say for argument that the market is built up $3 trillion are long holders and $1 trillion are short holders. Now I know that's a gross exaggeration of the market volume. This is spread out over 25 pairs, blah, 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 blah. But I'm just trying to simplify the math problem, okay? So bear with me a little bit. If I'm a dealer, or let's say you're a dealer, and you're holding massive open volume net long, in order for that net long volume to build up, what did I have to do as a dealer? When you click buy, I have to fill your order and sell to you. Take the other end of your trade. Okay? This is how the market works. Everything else is bullshit. Between 1 and 4 a.m., the dealer will widen the swing. Why does he do that, Steve? Why in the world would he widen the swing? Anybody here don't want to admit that they trade breakouts? The dealer widens the swing to pick up the breakout traders, trigger their stops, and drag them the wrong way. Okay? So if you've ever been whipsawed trading breakouts, understand that this is by design and meant to happen. After the dealer whips you out, you breakout traders out, he will then make his move. He will make an aggressive false move in this example because we know the market's holding net long and set the high of the day. So what happens is the initial high of the day is now broken and he extends it aggressively towards the upside. The high of the day is locked or sets in, the dealer will make an aggressive move back off of that number. Okay? What is he doing? Well, there's people that trade yesterday's high, might come in around here. They trade support or resistance breaks. The dealer will break above those numbers and come back below to trigger the stops of the people that have placed pending orders in this area here to go long as a continuation trade, and he will pull them and hit their stops out of the business. He will then make a secondary pass. The second pass is the dagger. He triggers the stops of anybody that got short, right? If you saw this and got short in here, you are now stopped out. But something really, I guess heinous is the right word that he does, is this. On the secondary pass, he may go above the first leg or not. The reason that he does it is this. He will validate the AB equals CD. People that project beyond here, he will validate those orders and then pull back immediately away from them. Okay? He will use a thing called a shift bar. Let me explain to you what the shift bar is, because as soon as I explain to you, you're going to say, holy crap, I've had that happen to me. Ever been in a trade that's been bouncing around -1, +2, +3, -4, back and forth, and then in the blink of an eye been down 15 or 20? That is known as a shift of the zone. It appears on one candle, one bar, whatever chart you're using. Here's what it does. The dealer has worked this area up in here. He has created an open float of either net longs or net shorts, depending. In this example, he's created some continuation of net long. When he has those traders in a trade, he has to get them to panic and lift their stop. He does this by a shift bar. He shifts the zone away from higher level longs in one 15-minute swipe of 25, 30, 40 pips. One candle, one bar that he gets the hell out of there with, and he gets everybody into a panic that has taken higher level long positions against the dealer's float. Do you understand? That's how, in the blink of an eye, you've been down big. Maybe you go on a coffee break. Maybe you put your order in, set your stop, set your limit, walk away. Maybe you're using a 50-pip stop. You come back, you're down 25, 30 pips. You don't know what the hell just happened. That's what just happened. The dealer has shifted the zone away from those level traders and nailed them. No, Bubba, shift. That's a good term for it. That's a pretty good term for it. All right, so look. They'll then, after the shift bar, they'll run the behavior on the other side of the spectrum. The outer fringes is where the dealers trap traders and make their money, right? Over here and over here. They will then end back in consolidation and accumulation. Here's why. If you owned a $4 trillion business, would you want to start from $0 the next day? No, you wouldn't. You wouldn't do that. You would leave some number of traders trapped overnight, causing them to pay, swap, and roll over, and you'd keep them hung there for 2, 3, 4, 5 days until they cry uncle and click out, or until you own their margin and clear them. Okay, here's a good one for you. Ever got the direction correct, been up 100, 125 pips, move your stop to break even, convert your spot to a swing trader, and then come back, and all of a sudden you're down to 60, plus 45. That comes from a lack of understanding the dealer cycle. the dealer will pull off of the high or off of the low 25 to 50 pips, depending on the pair, to end the day back in mid-level to keep the traders, higher level longs, lower level shorts, trapped until the next cycle, which begins again at 5 p.m. Okay? That's the reason that if you've been up big in a swing or position trade, it comes back down 25 to 50. Now you're only up 40 or 50 pips, and you're like, man, I should have took it when I was up 100. At end of day, dealers pull back and go back into an accumulation cycle to start over for tomorrow. Understand? It's by design. It's their job to keep you at bay. All right, so you have your accumulation phase. 5 p.m. day reset, dealers trade in the range. They widen the swing to pick up the breakout traders. They act against the contracts that have accumulated. They will, again, at the outer extreme fringe, create panic and franticness in the market. They will run the real trend against the higher level traders. They will do the same behavior at the low of the day. They will then pull off those numbers and go back into consolidation to end the cycle and leave the traders that they have stuck so they don't have to start at zero tomorrow. All right.